All right, let's get straight into it. Welcome to our latest explainer. Today, we're taking a highly clinical, totally transparent look at week 23 of the GoldMining Swissie recovery phase. If you've been following this account's journey, you know we aren't here for the highlight reels. Real accounts, real risk, real progression. That's what we do. We're here to analyze the actual, unglamorous mechanics of survival and stabilization in the Forex market.
Our focus today is on documenting the absolute reality of rebuilding an account after a significant setback. We're looking at a cent account trading the US dollar against the Swiss franc, the USDCHF pair. The objective here isn't to sell a dream or hype up massive wins. It's to look at the cold, hard data. And to truly understand where we're going, we first have to respect exactly where we are.
And where we are is sitting on a lifetime performance drawdown of negative 21.01%. No marketing fluff, no hiding the damage. Earlier in the year, this account suffered a major traumatic drawdown event. It took a severe hit, and that negative 21%, well, that's the hole we're currently digging out of. It's a brutal reality for sure, but acknowledging it is literally the first step in any legitimate recovery plan.
So let's talk about the reality of recovery. How do we actually steer this ship back on course?
It starts with a slow, highly disciplined process. For week 23, the account generated a 1.94% weekly gain. In absolute terms, that's a weekly profit of $35.96. Our closed balance currently sits at 1888.53 cents, and the equity closed at 1718.01 cents. These numbers aren't massive, but they aren't supposed to be. The goal right now is not to hit home runs and make it all back at once. The objective is simply to consistently put small points on the board without exposing our remaining equity to unnecessary danger.
Now let's look at the week 23 market drivers. What were the macro forces actually moving the needle?
To understand how those profits were extracted, we have to zoom out a bit. Early in the week, shifting Federal Reserve expectations really set the tone. Then by midweek, we saw movements in Treasury yields that fundamentally strengthened the US dollar. At the exact same time, the Swiss franc was experiencing fluctuating demand as a safe haven asset, mostly driven by broader global risk-on and risk-off sentiment. And of course, looming over everything at the end of the week was the Friday release of the US non-farm payrolls. This whole cocktail of economic data created some very distinct waves of volatility in the USDCHF price action.
Which brings us to executing the trade plan. How do we capitalize on those macro moves?
Pivoting from the macro news down to the micro execution on the 15-minute chart, think about how a system actually capitalizes on that midweek dollar strength. It doesn't try to trade every single ripple. Instead, it waits for the precise moment when the macroeconomic drivers, like that US dollar strength we just talked about, perfectly align with the technical indicators. The strategy caught a very clean, sharp upward bullish run. It got in, rode the momentum, and got out long before the market could turn.
Let's break down the absolute mechanics into cold, hard data. Only 2 calculated trades were required the entire week. Both were buy orders on the USDCHF, perfectly aligning with that dollar strength narrative. Both were executed with a very conservative 0.04 lot size. The first trade yielded $17.90 in profit, and the second brought in $14.23. Combined with a tiny swap adjustment, that brings us to our total weekly profit of $35.96.
Now, transparency is absolutely crucial here. Show, don't tell, right? When we look at the raw, unedited MetaTrader 5 terminal evidence, it validates those exact trades. The price levels, the timestamps, and the resulting $35.96 of profit are all logged right there. This level of transparency is basically non-negotiable when analyzing a recovery phase. We're not just taking someone's word for it, we're verifying the data directly from the broker.
Zooming out to the wider weekly summary, it confirms that 1.94% growth curve. But actually, scratch the profit for a second. Look at the loss metrics. For this specific period, the maximum consecutive losses sat at an absolute 0. The account took exactly what the market offered on those 2 highly calculated trades, and then simply stepped aside.
Stepping aside is a perfect segue into our next section, managing the risk.
Making money is one thing, but keeping it? That requires strict risk protocols. There's a stark contrast between the account's historical performance and its behavior today. The historical record from earlier in the year shows a massive, deep plunge, that catastrophic drawdown event that originally damaged the account. But compare that to the week 23 profile, it's incredibly flat and controlled. The wild swings of the past have been completely replaced by a tightly managed risk profile. The core theme here is clear. Recovery holds.
And the secret behind that beautifully flat drawdown line? the deposit load. The maximum deposit load barely scratched a nominal 0.35%. Maintaining this remarkably low exposure is the golden rule when you're navigating a recovery phase. If your equity is already compromised, you literally cannot afford to over-leverage. The system is keeping its footprint incredibly small, effectively tiptoeing through the market to capture gains without risking another catastrophic loss.
So, with risk managed, let's talk about the long-term goal, the road to $100.
We have to remember where this all began. This was originally a $25 or 2,500 cent account challenge. Today, despite the heavy drawdowns, the current balance sits at 1,888 cents, so we are still operating at a deficit. But the long-term target goal remains totally unchanged, 10,000 cents or $100. We've come a remarkably long way in stabilizing the initial damage, but there's an undeniable massive distance remaining to the finish line. Progress is slow, but crucially, it is measurable.
And that brings us to the close of our Week 23 explainer. We have to end on a realistic note. The recovery is far from complete. Market risk is ever present, but the discipline continues to hold. As the saying goes, recovery isn't built in a single trade. It's built 1 week at a time. It really leaves you with a question to ponder. When you face a 20% deficit in your own trading or in life, do you swing for the fences out of desperation, or do you have the discipline to rebuild it fraction by fraction? Thanks for joining me for this analysis, and I'll catch you in the next explainer.